All right, good afternoon, everybody. Hopefully everyone can hear me well. Welcome to Clayton McKervey's live video program. For those of you who are not familiar with me, my name is Tim Hilligus. I'm one of the partners at Clayton McKervey, one of the shareholders. And myself and one of our tax partners, Sarah Russell, are presenting kind of an update on what's going on with the political environment and how it might affect your tax planning for year end. We've got 2 of these planned in the next 2 weeks. And I also want to point out one of our tax managers, Miroslav Georgiev, who's going to help me kind of manage the questions. So as I said before, we've been hosting these events for a few months now, mostly connected to the PPP loan program. And with the election virtually, literally almost completed, I guess is the best way to put it. Virtually isn't the right way to do it, virtual. But we're getting to a point where we probably maybe no more than we did a month ago. And we had promised we'd have some discussions about where we might see the tax environment go. 2019, we've got 1 month, literally 1 month to kind of get 2020, literally about 1 month to kind of wrap up year-end tax planning and kind of do what we like to do. Sarah and I do this with most of our clients. You kind of do a straddle technique and look at where do you look at things that are happening in 2021 and 2020, and how might you use the skills or tools that we're going to present today to try to minimize your overall taxes. So real quickly, just a little bit of housekeeping. Based on the questions that people presented from our questionnaire or from the registration process, there were a few people who had some questions about individual and estate taxes. And I want to let you know that that's actually going to be next week, a week from today, same time, December 10th. And that's going to be with Margaret Amsden and Casey Haggerty. Margaret's one of our tax shareholders. Casey's one of our senior tax managers. And they're going to handle the individual implications of both the CARES Act, consistent and ongoing effect of the Tax Cuts and Jobs legislation, as well as the potential impact of what are the disclosed or proposed changes under a potential Biden administration in 2020. So for those of you who have individual questions only, you may want to check back in on December 10th, because Sarah's going to be covering primarily business tax implications of the current 2020 tax circumstances, as well as potential circumstances that we might face in 2021. A few things about the program and the process we're using. We have disabled the chat system, and we use a question and answer methodology. And if you notice in the question section, you're going to see that there's a little triangle in there that lets you rank the questions in priority. So if you see someone who's already typed a question, you can go ahead and hit that little triangle, and it'll let Miroslav and I know this is important to you. And we'll try to address those questions either real time, behind the scenes, typing answers, or address them through Sarah's presentation. Either she'll do it directly, or we may interrupt her and ask questions on the live video. For those of you who are familiar with my format over the last 20 years, I like to end these on time. Your time is important to me, it's important to Sarah, and it's important to Miroslav. Typically, we would end these at 4 o'clock. One of the things we started to do with the payroll protection program loan was we're staying on a little bit longer because there's been so many questions, and we're happy to do that. We'll figure out at what point we need to end, but we've got a little bit of time after 4 o'clock to continue to ask questions. So that may mean we stay live, and it may mean we address the questions through the chat or the questioning module within this program. That being said, if you can't stick around, no worries. Both the live video and the questions and answers will be available sometime after we wrap this up. Sarah and myself and Miroslav and our marketing team will go through this and make sure we put a bow on it and get it available for release so that you're able to follow up. Last but not least, don't hesitate to ask any questions. I wish I could see all your faces. I joked on a few of them before where I could, but I cannot. But I guarantee you, having done these types of events for 20 years, that your question is probably the same question somebody else has. So please, by all means, don't hesitate to get your questions in there, and we'll do our best to go ahead and answer those, okay? Let me see if I had anything else. We talked about uptick button, asking questions, follow up on December 10th, and I'll have a little reminder about December 10th as we're wrapping it up. So let me turn it over to Sarah Russell. Hopefully, those of you who are familiar with her from the PPP, you're going to get the same benefits of the type of stuff Sarah works on every day from leading our tax department.
Thanks, Tim. So just to go over sort of at a high level what we're going to talk about today, Tim sort of mentioned we're going to talk in very high level some things to think about that, assuming that our presumed president-elect Biden does hold the election and is, it's confirmed on December 14th when the Electoral College makes their final decision. We wanted to make sure everybody's aware of what types of things are in his tax agenda. We're certainly far away from those being a law, but it's good to have an understanding of where things might be and think about some things that you might want to do coming into year end in case the tax legislation is passed early in the year 2021 and is, ends up being retroactive to January 1st, 2021, which is certainly possible. And then I'll shift gears a little bit and talk about some planning opportunities in light of COVID-19 and some of the stimulus packages that have already passed to date. And then we'll talk a little bit about a couple other things to keep in mind, either with, COVID and the CARES Act, some IRS pronouncements that have come out, as well as where do we think stimulus might be, whether what's the update there in current events today. So if we hop right into Biden's business tax proposal, and again, this is just on the business side. It is not, we're not going to talk about individuals, but he's got a few things that are, certainly in Biden's tax proposal, we can expect tax rates are going to be increasing. His proposal increases the current corporate tax rate from 21% to 28%. And it proposes a 15% minimum tax on firms reporting $100 million or more in book income. Essentially, what he's trying to do is impose sort of an alternative minimum tax for companies that have significant differences between book income and taxable income. If you think about the Amazons and the Googles of the world who have been paying 0% tax, his agenda is to put into place something that rectifies that situation. He also is suggesting to enact a 10% offshoring penalty surtax on profits from any production by a U.S. company overseas for sale in the U.S. Again, there's no details on this proposal really, so we don't know how these types of proposals will really be implemented, but it certainly is, his point is to try to encourage manufacturing in the United States if you're going to sell that product in the United States or provide services in the United States, to make sure that those types of jobs stay in the United States. He proposes to expand the work opportunity tax credit to include military spouses. Right now, there's a work opportunity tax credit for certain employees, whether military, potentially people who are coming out of prison. There's a potential credit out there. He's going to expand that a little bit. He creates a 10% Made in America tax credit. There was a lot of talk about this on the campaign trail, but don't really exactly know what that means. But some sort of credit methodology, we don't know what it would be based on, to support manufacturing in the United States. The big one for a lot of our clients is he's going to end the qualified business income deduction. So currently, owners of LLCs and S corporations get the benefit of a 20% qualified business deduction. And he's going to put an end to that for taxpayers making more than $400,000. This will be a big change for some of our clients and sort of going back to pre-Tax Cuts and Jobs Act tax rates. And then this is a little bit individual, but will also impact the business community. He's suggesting a FICA tax change, which essentially what his proposal is to create what they call a donut hole in in the FICA tax, where you currently the FICA threshold is $137,700, and he's suggesting that that threshold still stays in place, and once it goes above $400,000, you will be once again subject to FICA tax, and it will be both employee and employer. So the employer will share 6.2% of that, as will the employee. And the big challenge for this will be if something like this gets enacted, is currently if you are a partner in a partnership or an LLC and you are active, the income from that partnership or LLC is considered self-employed income and would be subject to this FICA tax. So this would be a huge tax burden in a partnership or LLC environment. And if something like this does in fact pass, I think we will probably see maybe some conversions where possible to an S corporation. And then the other big thing that his plan does is it repeals like-kind exchanges. This is really impactful for the real estate community. If you're investing in real estate, there's a lot of times you can do a like-kind exchange to defer gain. And his proposal repeals that ability to defer the gain on those types of transactions. Margaret will talk a little bit more about the individual and estate tax proposals, as Tim said, on Friday, and get in a little bit more detail on some of that stuff.
And Sarah, one of the things I want to mention is you and I deal with this every day. And so when we read this type of information, the one thing I want to make sure the audience understands is this may be a starting point, but what happens is whenever this type of criteria or cutoffs or thresholds are proposed, very often what happens is somebody measures the economic impact and the dollar impact. So I heard in the political campaigns, like, oh, it's everybody over 400,000. And we've lived through where those thresholds change because 400,000 doesn't raise enough revenue for the government, and they move it down to 300, and that becomes part of the Democrat legislation, the Democrat, Republican, the House, Senate type negotiations. So I want to make sure you guys understand that this may be his starting point, and what ultimately occurs could be significantly different based on the economics of each one of these proposed changes.
Yeah, absolutely. Again, this is a far way away from being legislation and actually being enacted. It's just to give you an idea of what is his agenda that he's trying to accomplish. I think we can probably be pretty confident that what is in his current agenda will change, both because he may have to compromise with Republicans to get something passed. I think, keep in mind and keep an eye on the Georgia Senate runoff election that's going to be happening at the very beginning of January. If two Democrats win that election, the likelihood for Biden to be able to pass his agenda the way he wants to significantly increases, because that will give the Democrats control of the Senate, because the vice president will be the tiebreak vote in that instance. Whereas if the Republicans win even just one of those Senate seats, the likelihood for more compromise increases. And, I think we would more likely see something much less in scope to be passed, especially initially, than what Biden may like to see happen. He's already come out and said that, his first legislative action and then his first, his first priority is going to be additional stimulus. So tax legislation may take a backseat to that, depending on where we end up with the pandemic as we get later and later into 2021. A couple other items that are in his proposal. Currently, if you're doing business internationally and you have a controlled foreign corporation, you have to deal with what we call the GILTI regime, and it's essentially a tax on profits earned in a controlled foreign corporation, and that tax rate is currently 10.5%. Biden's proposal increases that to 21%. We're not quite sure how that's going to work, but that is he wants to make some changes both to the tax rate as well as to how that computation works. So in reality, the GILTI tax rate may actually increase a little bit more depending on how those math calculations end up working. He wants to end incentives in the 2017 Tax Cuts and Jobs Act that allow multinationals to significantly lower taxes on income earned overseas. And really what that is currently dividends paid are not taxed. So if you get a dividend from a controlled foreign corporation up to the parent company in the United States, that dividend won't be taxed at the C Corp level. It won't be taxed until a dividend passes out of the C Corp to its actual individual shareholders. That was part of the Tax Cuts and Jobs Act, and he wants to repeal that. And then he also wants to establish a clawback provision to force a company to return public investments and tax benefits if they close down jobs here and send them overseas. So he really focused on making sure that he can implement legislation to keep jobs onshore. When you look through his proposal, that's what a lot of these things are meant to do, in addition to raising taxes. There's been a lot of spending happening over the last 9 months, and I think most people foresee there will be a tax rate increase at some point in the future to pay for the stimulus packages that have been passed to help us as we get through the pandemic. It's just a matter of time and when that will happen and how. The other item that Margaret will cover in a lot more detail is proposed changes to the capital gain rates. I wanted to mention it here because if you are potentially in the midst of a sale of your company, or you're consulting with a business that's in the process of potentially selling their business, and you're looking at, oh, well, we could close on 12/31, or we could close the first or second week in January, not a big deal. His capital gain rate increase, he proposes to raise capital gains rates on high income earners. I think it's above $1 million to be the ordinary income tax rate. So if you are selling your business and you're looking at 2 weeks timing, 12/31 or January 5th, to try to accelerate that to happen at the end of the year, to make sure that you protect that 23.8% current capital gain rate and you don't get stuck paying a lot more taxes if legislation does pass and it is retroactive. We're sort of looking at saying, hey, make sure to try to close that if you can before the end of the year, so that you don't end up paying an additional 20% taxes that you weren't expecting on that deal. So when you look at what's happening and you think, what should I be doing today in case this tax legislation does pass? A lot of times when we're coming into the end of the year, our tax planning strategies are generally to accelerate deductions and defer revenue. Well, when you're in a year where you think tax rates may be increasing in the following year, it's actually opposite, considering accelerating income and deferring deductions where possible. We're not saying to do anything outside the lines of the law, but if you are trying to close sales and it's, I'm either going to make this sale January 3rd or I'm going to make it on December 29th, maybe go ahead and push it out to January 3rd if you can. Similar with deductions, if you're looking at prepaying big expenses to take deductions in the current year, look to see if it might make sense to defer some of that into January of 2021. As I mentioned in the last slide, accelerate M&A transactions if possible. Model the tax impacts of expansion opportunities. If you're looking to expand and you're debating whether or not you're going to do international expansion versus domestic expansion, you should be working with your accountants to help you understand, if I make this decision and I'm going to go internationally on this expansion, what could the potential cost be? Because you don't want to just look at what the cost of, the tax cost would be today. You want to think in the future as well, knowing that we have these proposed tax rate increases coming, especially for international type operations. And then if you're a multinational company, review your global tax plan, including transfer pricing and structuring of how and the structuring of your foreign subsidiaries. and just making sure that, if you're making decisions at year end, you're looking at it through the lens of what could potentially happen in 12 months or, 12 to 18 months time, or even less. You hate to set up a structure today that you think is going to work for you, and 9 months down the road, you realize that it was the wrong decision. So I would just caution you to make sure you're modeling some of this stuff both ways. So you go into those types of things eyes wide open.
Hey, Sarah,
Yep, go ahead.
No, first of all, I agree with everything you're saying. I mean, and obviously hindsight is 2020, but when you look at the stimulus that's occurred in 2020, and you look at the potential for another stimulus package, potentially, let's say by the end of the year or into 2021, at some point when Congress looks to balance a budget or look at how do we manage some of these costs, it's likely Republicans and Democrats are looking at raising taxes somewhere within the corporate and individual process. And that could be, like you described, just simple increases. It could be eliminations, like you mentioned, with the flow-through deduction, the qualified business income deduction. So I agree with it 100%. Now, we have a question that kind of ties into maybe more the philosophy of President-elect Biden. And somebody's asking a question, Sarah, about the possibility of eliminating the tax advantages of the opportunity zones. And I look at it as it may seem on the surface similar to the president wanting to eliminate like-kind exchanges. But one unique thing about the opportunity zones is they don't really have an impact on your income. Anybody qualifies for that deferral, but they're geared towards an incentive to invest in certain areas. And so that may make it different than the benefit of just deferring taxes under a traditional like-kind exchange methodology. What are your thoughts?
I totally agree, Tim. And in fact, when I was looking before the election happened, looking at the chart, the comparison of Trump's tax plan to Biden's tax plan, there was nothing in Biden's tax plan that actually eliminated the opportunity funds that I have seen. That's not to say that it couldn't be on his agenda down the road, but it's not in his immediate agenda. It doesn't seem to be. What I might see happen, if you think about the Democratic philosophy or the Democrats' philosophy, is maybe tightening up what is considered and qualified as an opportunity zone, because those opportunity zones were really meant to try to spur economic development in more disadvantaged communities, to sort of change those communities around. And so I would see maybe that staying in place, but tightening up what types of zones are qualified. Because as we've all heard, there were certainly some pretty nice neighborhoods in the Manhattan area that were qualified in the opportunity zones, and that may come away. But I haven't seen anything where he wants to actually do away with it.
I think one of the other challenges with the opportunity zone tax incentive is it straddles such a long period of time. And so legislation would really kind of throw a monkey wrench. It's one thing if tomorrow a capital gain I have goes from 20% to 28 or something like that. It's another if in a 10-year window I gain basis and I might have appreciation that is never taxed, and say, well, we're going to change the rules. Maybe anything that happens after a certain point. So it certainly could happen. You can tell from, I think, Biden's theme, President-elect Biden's theme, that he's looking for elimination of deferrals. The overseas investor who's got investments overseas where they're deferring taxes, have big tranches of cash offshore, and eliminating like-kind exchanges. It does have kind of a theme, and so it could be at risk. So, good. Thanks, Sarah.
Sure. So unless there's any other questions related to Biden's tax plan as it relates to the business community, I was going to jump in and start talking about some year-end tax strategies to make sure you're talking to your accountants about as it relates to coming into the end of 2020 in light of some of the legislation that has been passed this year. And we're not going to talk about the general stuff that we talk with our clients about on an annual basis. I'm really going to focus on some of the opportunities that exist in some of the legislation that has been passed with the stimulus packages that we've seen come through during the year to make sure that you're not losing sight of some of these opportunities. So I'm going to focus on just really 5 things. And I'm going to talk about NOLs and some of the opportunities that were written into the CARES Act as it relates to net operating losses, as well as excess business losses, which excess business losses is a concept that's really only applicable to flow-through entities. I'll talk a little bit about bonus depreciation, some reminders there, talk about some state and local considerations, and that this isn't really in light of the CARES Act, it's more of things to be thinking about in light of COVID in our working environment. And then I'll touch base on PPP expenses and where we're at there and some reminders as it relates to those things. So when we look at net operating losses, before the Tax Cuts and Jobs Act of 2017, NOLs were allowed to be carried back 2 years, carried forward 20 years, but there was an AMT limitation of 80%. Once the Tax Cuts and Jobs Act was passed, there was no carryback allowed, but there was an indefinite carry forward. So those losses wouldn't be lost. You could carry them forward indefinitely, but you could only use them up to 80% of taxable income. So you would still have some tax bill left at the end. The CARES Act put a pause on the Tax Cuts and Jobs Act and said any NOL incurred post-Tax Cuts and Jobs Act and before January 1st, 2021 can be carried back 5 years. It can still be carried forward indefinitely. And it also put a pause on the 80% income limitation. And what this opportunity does, if you had a loss in 2018, 19, or 20, and I think, the intent of this was thinking that maybe a lot of businesses will end up with a loss in 2020, you can carry that back 5 years. And if you go back to 2015, tax rates were higher. So this allows you to carry an NOL that if you weren't able to carry it back, if you were in a corporate environment, today would be worth 21%. If you carry it back to 2015, it makes it worth 35%. So there's a big rate differential there that you can play with. So thinking about those things, if this is, sort of a little bit contrary to what we talked about with Biden's tax rates going up potentially in 2021, maybe it does make sense to accelerate deductions to create a loss so that you can go back and carry it back to a year in which tax rates were a lot higher. And I'm going to show a couple of examples. I'm going to get through a few slides and I'm going to show a couple of examples here in a minute. So the one thing, a couple of things to think about when you do carry back these NOLs, and if you had an NOL in 2018 or in 2019, you should if you haven't already filed those carryback claims, you should certainly think about doing so to go back to those years of higher tax rates and get those refunds instead of carrying them forward against years in which the tax rate's only 21%. If you're in a flow-through environment, a little bit different, but it does get a little bit complicated because those years had AMT. AMT still existed in those back years. So when you do the carryback claim, it actually requires you'll end up with some alternative minimum tax in that year that you can get refunded in 2018, 19, or 20. So there may be some additional, you may have to carry back the return to 2015 and then also amend a 2018 or 2019 return to get that AMT refunded. It's a little bit of a timing difference. The carryback claims get processed a lot faster than the amended returns, but it's still cash that will come back to you. When you're thinking about going in through this year at the end of the year, if you haven't, if you're eligible to switch to a cash basis method of accounting, this may be the year to think about doing it if you didn't already do so, to create that net operating loss to be able to carry back the net operating loss to those higher tax years. And then making sure that you're electing bonus depreciation if it makes sense in order to create a tax loss. This year is a really good year to have a tax loss because you can carry it back and because of that rate differential. So if we look at, so that's in the corporate rate. In the flow-through rate, if you're a partnership or an LLC, the concept since the Tax Cuts and Jobs Act is this excess business loss limitation. And the Tax Cuts and Jobs Act said, if you have a business loss, you're going to be limited to the amount of non-business income that can be sheltered from that loss. And the limitation is $500,000. So if you had wages of $750,000 and a loss in the business of $1 million, you would only be able to offset $500,000 of your wage income, and you would end up paying tax on $250,000. The CARES Act repealed that limitation for 2018, 19, and 20. So if you had a loss limitation in 2018 or 2019, hopefully your 2019 return was filed correctly because the CARES Act was enacted before 2019 returns were due. But if you didn't, making sure you amend those returns to take full advantage of any business losses that were incurred in those years. And if you have any carryback, these losses can also be carried back. Same 5-year carryback is allowed as with the corporate rates, and the same indefinite carry forward. It also, similarly within the corporate world, it limits, it put a pause on that 80% income limitation. So there is no limitation on how much NOL you can use. However, individuals still have alternative minimum tax to consider. So there will still be some AMT considerations as you're going through and crunching numbers to see how much money you're really going to get back. The other thing to think about, especially if you have business losses in the current year, is this is a great year to consider Roth IRA conversions, because if you have a loss in your S Corp or partnership or LLC, this is the year that it can shelter any income that may come through for a Roth IRA conversion. Margaret will probably talk a little bit more about this in the individual, but I wanted to mention it here because the business loss and the Roth IRA conversion sort of go hand in hand. Tim, you have anything to add here?
No, you stole my thunder, though. I had that comment further down where I was going to mention if they're in that loss situation, being able to now utilize your itemized deductions or your $24,000 standard deduction is a great way to take IRA dollars and make them not taxable. So,
yep.
Good job.
Good. One of the things the CARES Act did this year was, so when the Tax Cuts and Jobs Act passed, there was a technical glitch in the way the legislation was written, and qualified leasehold improvements were not considered qualified property for bonus depreciation. The CARES Act fixed that technical glitch. So now qualified leasehold improvements are eligible for a shorter 15-year life again, and it made it retroactive to the date of the Tax Cuts and Jobs Act. So this is applicable for 2018, 19, or 20. So if you did not take bonus depreciation on qualified leasehold improvements, you may want to amend those returns to take that bonus depreciation, or you can do it by just filing a change in accounting method. It's called Form 3115, and that deduction would flow through on your 2020 return. But a lot of times if you've purchased a building and you had a big build out, making sure you do go forward and do a cost segregation study to be able to take advantage of this accelerated depreciation, especially if it potentially could create a loss that you could carry back again to those higher tax years.
Yeah, and I think Sarah, you bring up a good point. There's two methodologies, an amended return or a change in accounting method, and the difference would be the year you're able to carry the loss back. So if you're thinking for a 2020 return, that 5-year carryback is different than amending a 2019 return. So you really, in the 19 case, you might get a little bit of hindsight to be able to understand, should I amend the return or just utilize the loss on my 2020 return?
Yep, absolutely. So I wanted to walk through, talking to like a lot of high level terms, but I sort of wanted to walk through an actual example to show how bonus depreciation can create a loss and what the potential refund and cash flow impact of that could be. So if you're a C corporation and you had taxable income before bonus depreciation of $100,000, you would have tax of $21,000 due. The tax rate's 21%, so pretty easy math there. But if you purchase some new or used equipment, because if we remember, the Tax Cuts and Jobs Act allows bonus depreciation to be taken on new and used equipment of $200,000, you now create a taxable loss of $100,000. And that $100,000 loss can be carried back 5 years. So if you go back to 2015, the tax rate, and I assumed again that, $100,000 taxable income, but the tax rate's about 35%, 34% in 2015. So that would create a refund of $34,000. So if you look at this, you say, oh, I have some CapEx expenditures coming up. Maybe don't wait until January to do them in December so that you can take advantage of the bonus depreciation. It's not that bonus depreciation is going away in 2021, but the ability to carry back an NOL is not available in 2021. And this creates a positive cash flow impact of $55,000. Not only do you not have the $21,000 current year tax bill, you're going to get the $34,000 back on the carryback return. So, don't just keeping in mind the cash flow that can come from this. And if you're selling equipment, this is a great reminder to your customers of potential help for financing that equipment that can come from if they're in this type of situation where bonus depreciation would create a loss for them.
I think it's really important to realize that a lot of what Sarah and I and Miroslav do on a daily basis relates to deferring taxes. Yes, we're trying to minimize our clients' taxes at all costs, but a lot of the strategies, accelerating depreciation, things like that, electing cash basis, very often you're kicking the can down the road. You're pushing and deferring taxes, taking advantage of time value of money. In the case of being able to take a $100,000 loss and either know that you can use it for 21% currently or carry it back and get 34%, you're looking at a 13% gain in value. That's not a deferral, that's an actual return. So when we've talked to our clients about, when you buy a piece of equipment and you take that tax deduction and your tax savings helps towards the down payment, here's actually a real contribution of cash towards the down payment, being able to go back to a higher tax year.
That's right. And so I wanted to also run through an example for a flow-through entity, because again, we have this concept of excess business loss that existed before the CARES Act, and it goes back into existence as of 1/1/2021. So if you have a loss from your flow-through business, and in this example, I put $600,000, and the reason I did that is because of the $500,000 limitation. And you decided to sort of push some CapEx expenditures into December of 2020 to give you an extra $200,000 of bonus depreciation. So your total loss is $800,000. Before the CARES Act lifted this excess business loss limitation, you would have had a tax liability of $13,579. In this instance, because of the CARES Act, you would create a taxable loss of $200,000. You would be able to offset all of your income, your wages, interest, dividends, cap gain. If you had an IRA that you could convert, $200,000 IRA that you could convert to a Roth IRA, then you would create zero taxable income, and that Roth IRA conversion would be tax-free. So something to think about there. But if you didn't have that, if you didn't have $200,000 of other income that you wanted to shelter, you were going to go ahead and carry back that $200,000 to 2015. Again, the rate differential in this case is 10%. You assume the flow through tax rate is 29.6%. In 2015, the highest tax rate was 39.6%. So in this instance, you end up with positive cash flow of $85,565. And that's really the difference between the tax that would be paid before the CARES Act and this refund that you'll create by carrying back. It's the combination of the two by carrying back that loss. So, but again, that loss essentially becomes worth 10% more because you're allowed to carry it back to higher tax rate years. So when we think about state and local considerations, I think one of the big overlooked issues is how are remote workers going to impact your state nexus? If you're one of these companies who had employees who moved outside of the state that you're used to operating in they're still there, say 9 months later, if you're still working virtually like we are here at Clayton McKervey, there's some you really need to be aware of the potential nexus and therefore tax liability issues that this can create. All states have not issued guidance on how they're handling this. In fact, approximately 20 states have issued no guidance on whether temporary remote workers will create nexus. Some states, not many, have expressly waived nexus for temporary remote workers, and some have indicated that nexus will be created, that they're not going to change their nexus threshold. And in general, a remote worker in that state creates nexus, so you'll have an issue. Some states have also issued guidance on how remote workers will impact apportionment and allocation calculations, and some have not. And apportionment and allocation means how are you as a company sourcing your sales? And sales usually, the percentage of sales in a state often drives how much income in that state will be taxed. If you had $1 million of income and your apportionment factor for sales was 20%, you would likely pay $200,000 of tax in that state, or $200,000. You would pay tax on $200,000 of income in that state. And so states are going through and trying to figure out how they're going to handle this new remote workforce that now may be creating not just income tax nexus, but also sales tax nexus. And as we know, states are looking for revenue generation, so they may get aggressive on how they want to handle this. And in those situations, you also have to be aware that you may have payroll tax withholding that you didn't do right during the year, as well as state unemployment issues. So there's a lot of state and local considerations, and there's also not, there's a lot of states haven't issued any guidance on it. So we're sort of in this environment, not unsimilar to when we were talking about PPP, of lack of guidance and sort of just trying to figure things out as we go. Tim, anything you wanted to add on that?
No, I think you hit the nail on the head. Payroll taxes, sales taxes, and income taxes. Every state's going to kind of have their own methodology, and what I think we're saying to our clients is you kind of have to assess the risk. That certainly should be a factor. You should be cognizant of it, and I would be prepared for any kind of notifications or notice you get, because these states are very aggressive. They use a commission type system for third parties to try to generate revenue for them. And I think you just got to be prepared for, where are my people working? And is it creating either income or withholding nexus for me? Yeah.
I mean, sales tax nexus is always an issue. If you had an employee who was in Montana and you said, oh, I only have $10,000 of sales in Montana, you probably don't really have any risk. But if you have an employee in, say, Florida, where you generally don't, Florida's not a good example, In Illinois, where you generally don't file, and you have $1 million of sales in Illinois, then the risk is a little bit larger.
To me, when you think about what we talk about with our clients on an annual basis, one of the first ones is where are you shipping your products, where are you providing your services? And now, if because of remoteness, because of COVID, you've got an employee in that state where you wouldn't have, it definitely should be on your radar. Then, there's an alternative side to that, that you and I deal with every day, and Miroslav deal with every day, and that is, making sure you don't pay double tax in those states. So if Illinois is going to tax your income, make sure it's not in your Ohio or your Michigan tax.
Yeah, absolutely.
There's a little bit of a juggling there.
Yep. So I said, I let you know, I talk a little bit about PPP expenses. So as we know, the CARES Act said loan forgiveness would be excluded from income. However, the IRS came out with guidance and said, it may not be included in income, but you're also not going to get the deduction for expenses incurred where loan forgiveness income was excluded. So essentially, to the extent you're expecting to be have a loan forgiven, you cannot take the deduction for what the expenses that you use that loan for. And on November 18th, 2020, so all along we were uncertain, would this be a tax event in the year you found out about forgiveness, or would it be a tax event in the year you knew about forgiveness? And since a lot of our clients haven't applied for forgiveness or don't expect to get a determination on forgiveness until potentially 2021, we were uncertain which year it would go. On November 18th, the IRS came out and said, if you reasonably expect to get your loan forgiven, you cannot take the deduction in the year that it was paid or incurred, which is generally 2020, even if you have not applied or received a determination on loan forgiveness, which means it's a 2020 tax event. The IRS has maintained their position all along that if in order to fix this issue, there needs to be an act from Congress. Congress needs to specifically indicate that the PPP expenses are deductible in any legislation that gets passed. So I say don't forget to include this as an adjustment in your year-end tax planning, because this is not sitting on your book income, or it shouldn't be sitting in your book income. So it'll be an add back and sort of a surprise. It sort of makes the PPP loan, 30% less valuable than what we thought it was going to be. Now, go ahead.
I was just going to say, I think it's really important to know that the way the states are handling this could change. States that comply with the IRS rules or with your federal tax treatment are already drawing some lines in the sand, meaning, hey, they agree that the loan forgiveness is not going to be taxable in our state. And we agree now that the expenses that created that forgiveness of income will not be deductible. Let's say Congress makes those expenses deductible. I know, for example, that Mississippi is saying right now they will not allow the deduction for those expenses. So Mississippi would have a difference between what your federal treatment might be. So I think everybody needs to be careful. Michigan has done nothing. So we don't have anything for Michigan for remote workers. We don't have anything from Michigan on PPP. So we're going to be in a wait and see mode for our state.
Yeah, a lot of states have said, a lot of states have just said we're conforming to the federal guidance, and that's what we're going to do. You've got some states that are anomalies, but I think, wait and see. But the state issues on this are pretty. There's a lot of state issues as it relates to the CARES Act in general, because there's a lot of the states haven't issued guidance on how they're going to treat some of these things. I wanted to go back to these PPP expenses for a moment, though, because one of the things that I think has not gotten a lot of attention is because if you are a company that is taking advantage of the research and development credit, because these expenses are no longer deductible under the tax code, they will not be considered qualified expenses for purposes of calculating the R&D credit. Payroll costs are generally a pretty significant portion of the credit calculation. So this will have a potential big impact on how much credit you're generating, especially because the credit, the way the credit is calculated, it's, you get more credit if your research is increasing. So if you exclude all of this payroll from that credit calculation, you could be in a position where you're generating no credit because of the math computation that's involved. So what we're doing for our clients is we're sort of looking at their loan forgiveness and saying, well, if we exclude this subset of employees who are your highest paid engineers or your highest qualified employees, as relates to the R&D credit, where would you be at with forgiveness? And does it make sense to exclude them? Because a lot of our clients can still achieve 100% forgiveness without including them because they extended the covered period to 24 weeks. So we're doing a little bit of modeling the credit calculation with and without the expenses and making sure that, you don't take, if you would generate a $500,000 credit if everybody was included, but you would generate a $100,000 credit by excluding all of your R&D payroll costs, is your loan forgiveness at least $400,000 to make up? Are you going to be cash neutral on that? Or does it make sense to not have all of your loan forgiven and exclude some of the payroll so that you can maximize your R&D costs? So there really is a cash modeling that you should be doing if you're generating R&D credits to make sure that you don't, you're not cash negative when you end up at the end of the day. Now, that all being said, there is some movement and there may be some hope on the horizon. There's, another stimulus package could be passed before year end. There's been some movement this week and maybe a glimmer of hope. Monday, Pelosi and Schumer sent McConnell a proposal. There's been no actual publication of what was included in that proposed stimulus package, but it's rumored to be about $1.3 billion. We don't know what the contents of that are. I assume there's a lot of state and hospital funding in there. And on Tuesday, the Problem Solvers Caucus put forth a bipartisan bill, and that bill includes specific language that does make the PPP expenses deductible. So maybe we have some hope on the horizon that we'll get a fix from Congress before the end of the year on this. We'll see. Pelosi and Schumer indicated that they thought it was a good starting point for negotiations, and McConnell today said it was progress, that he sees some progress with Schumer and Pelosi coming to the table and willing to negotiate. I think it's a good sign that they're not still stuck on a $2 trillion bill that they were prior to the election. Maybe there will be some compromise. And there's also been some indication that if they can't pass a full-blown stimulus package on its own, that some of this legislation may get included in the spending bill that they are trying to pass before government funding runs up on December 11th. So be cognizant and be thoughtful of the cash that's going to be required if your PPP expenses are not deductible. But maybe we have some hope that this, in fact, will be deductible and you won't have to actually pay tax on it. I don't know, Tim, what are your thoughts?
I think it's kind of unfortunate that we don't have some conclusion on this sooner. We've got 28 days for the people in our audience here to determine the impact of that PPP loan. And I'm not going to lie, we've got clients who've had record years within our client base because of what they're doing. And we don't have a practice of restaurants and businesses like entertainment businesses have been shut down. So I can't necessarily relate to them from a client relationship standpoint, but I think that for those of you who may be involved in those environments, it might be a surprise that, while you've got a break even or have a loss year, that loan forgiveness might actually put you in a tax situation where you actually have to pay some income taxes and the cash isn't going to be there. I will say this, always file your tax return on time, even when you owe taxes, because you avoid the failure to file penalty, which is 5% a month. But I think it goes back to the same thing we had with the PPP. It's just going to create anxiety for closely held businesses, mid-sized enterprises, and not knowing, am I going to owe a bunch of tax on April 15th that I wasn't expecting? You know, you gave the numbers. For C Corps, it's going to be 21% of their loan forgiveness. For S Corps and partnerships, it could be as low as, it could be 29.6 based on the flow-through deduction rate. So that could be pretty sizable for businesses not knowing or not expecting to have a tax bill right now. So I hope they do something sooner than later. The one thing about, you mentioned it earlier, and knowing a bit about how tax laws are enacted and how they work, you know, sometimes you worry about retroactive tax laws and will they be retroactive or not. And one of the things they look at is have we given enough notification through our language, through our desires before the actual legislation got passed. And, you know, they've given some notification way back in May. I remember in May there were two bills that were presented that were supposed to be voted on to take away the tax consequences of losing the deductions of these expenses. So maybe that'll be enough if they do something down the road and say, hey, this is going to fix 19. But I feel it's probably as uneasy as our clients do, and that is it'd be much better to know right now that Congress is absolutely going to do this. It'd be great if they would commit to that and kind of let everybody understand their cash flow needs, because January 15th for individuals is coming around the corner. December 15th for C Corps who've got to make fourth quarter estimates, it's days away. So.
And I mean, I think everybody's trying, you know, everybody's generally cash flow planning before the holiday, and those fourth quarter estimates, even if they're due on 1/15, are part of that cash flow analysis. And yeah, you know, it's a huge chunk of change and make a big difference for a lot of our clients. We'll see, you know, if they're gonna fix it easily, maybe we'll know by next Friday if they're able to come to some agreement on the spending bill. Maybe they'll slide it in there. I don't know. It does concern me that the last Republican bill didn't include a fix for this.
Right. That was surprising. I mean, they were the ones back in May. The Republican Party was pushing it significantly from pressure from their constituents. So, hey, we're at 3:59. There's a couple comments I want to make. We got one question here from Tim on the PPP EIDL aspect, and I do want to get to that. But there's a couple things I want to make sure people understand, because if you look at the hundreds of people that are attending this webinar today, they're across many different areas. We've got controllers, we've got bookkeepers, we've got business owners, we've got other professionals, we've got attorneys, we've got financial advisors. So everybody's kind of got their understanding. I want to make sure everybody understands that when Sarah's talking about generating losses and you've got a flow-through entity, you do have to talk to your tax advisors, because there are what's called basis limitations. You may be able to create losses and not be able to deduct them to generate those NOLs. So I want to be really careful that for those of you who are strategically considering this, maybe you can do a cost segregation study on your building. And if you do a cost segregation study, you could do the change in accounting in 20 or in 21, depending on how it might benefit you. But the key thing would be to understand, do I have the basis or the wherewithal to deduct those losses? You may have to create basis before the end of the year. Perhaps you loan money to your S corporation, but there's strategies to create basis to allow you to take those deductions, pay yourself back in the future year, which would put you in a negative basis situation. But there is no such thing as negative basis, right, Miroslav? Yeah.
Correct.
Tax joke. That's a tax joke for those of you who don't get to hear tax jokes very often. This is what I do. But I think it's really important. I just want to make sure you know you can't just generate losses, deduct them willy-nilly without having some analysis done to it. And the second thing is, again, with flow-through entities, started last year, picking up this year, we've got requirements to disclose your basis within your tax returns. So that's going to be important. We have plenty of clients who file their own partnership tax returns, maybe for their family, their business building or something like that. They just, for whatever reason, and I know in looking at the audience here, there's probably many of you might be preparing those same forms. Well, the basis in a partnership return is going to be required information with a 1065 for 2020. And I want to make one last thing. There is a difference between a Section 179 deduction, which the limit is $1,040,000. That's pretty substantial, but it's different than a bonus depreciation. Bonus depreciation allows you to generate losses. Section 179 does not. You might say, well, aren't they then universal? No, because first of all, Section 179 can't create the loss, but if you then switch fully to bonus depreciation, you still want to potentially manage that loss, because you've got to actually make an election potentially out of bonus depreciation, because as Sarah mentioned earlier, it's based on the class of assets, all assets within a class that you add to your business in a particular year. So main idea here, don't overlook some of those things. We're scratching the surface with, I think, some very, very good ideas, very good sound advice that potentially create an arbitrage and get bigger tax dollars back in carrybacks, maybe accelerate income, consider accelerating income in 2020 if you think 2021 might be a higher tax rate for you. But you can't do it without talking to professionals and making sure you're getting kind of that whole picture.
Yeah, we can't give you all of the advice in 1 hour. There's not nearly enough time, and we're not able to analyze everybody's situation. We can give you some ideas and share some potential opportunities, but they certainly have to be vetted out.
And Tim here is asking a question that I don't know the answer. I think I have an idea of the answer, and so
I don't know the answer either.
As Sarah mentioned, part of the PPP loan criteria is you get this loan, the loan gets forgiven and it's not taxable, and as it stands right now, you would not be able to deduct the expenses incurred that created that loan forgiveness. So if you had $1 million loan and it was forgiven, then $1 million of either your rent, your utilities, or your payroll is not going to be deductible. Now, for those of you who've already filled out your loan application your forgiveness application, you probably are aware that within that it asks you, did you get an EIDL advance? And I think that was up to a $10,000 advance. They called it a grant at the time. It was originally supposed to be $10,000 regardless, and then they put some criteria that benchmarked it based on employees. So what I don't know is, since the EIDL was a grant, and if you got $10,000, it was irrelevant of what expenses you may have incurred, and it's not taxable income. What I'm not sure of is does it have the same treatment that the PPP loan? So in my example of $1 million PPP loan, I'm not sure if you have $990,000 of expenses that you can't deduct, or if you have the full $1 million of expenses you can't deduct. But we'll try to find that answer out. I just don't know it at this point. We are still generating applications for forgiveness for our clients, and I'm sure this question has come up by someone else. I just haven't faced it yet. Have you?
Yeah, I haven't faced it either. No, I have no idea.
Yeah. All right. Well, I want to say thank you, Sarah. Thank you, Miroslav. Miroslav really does serve a role depending on how the questions that flow in and if things come up. So I appreciate his stepping in at the last minute to kind of help out. Want to thank all the participants. Appreciate the investment that you have in our information. Sarah and I greatly appreciate it. We try to put as timely and valuable information out there as we possibly can. And just real quickly, 2 reminders. Number 1, our marketing director, Denise Asker, with her team, hopefully will be reaching out to each of you with some kind of connection for the live video replay if you need to take a look at this, but also, we only had a couple of questions, so access to the questions. So there will be availability for you to follow up on these items. Don't hesitate to reach out to Sarah or myself or Miroslav if you have questions that come to you after this. And the last thing I'll leave you with is, a week from today, Margaret Amsden, our shareholder in our tax department, one of our personal income tax and estate experts within the firm, is going to be presenting along with Casey Haggerty, one of our senior tax managers who's also heavily involved in estate planning. And they're going to cover the impact from the Tax Cuts and Jobs Acts all the way through the CARES Act, and similar to what Sarah did, kind of address what the prognosis might be of potential Biden tax legislation in 2021. So again, thank you all so much.
And also, lastly, on December 15th, we'll have a final PPP check-in.
Yeah, is that with RMA, correct?
That is with RMA.
So for those of you who are interested, we're going to have Sarah said final. You can't say final.
I don't know why I said that.
You got more days coming, so there's a good chance that there could be more, especially if we get to a point. We've always said, for those of you who participate in our PPP program, if there's something that comes about, we're going to absolutely jump back online and try to share our knowledge with you. Right now, we're heavily entrenched in the calculations of the forgiveness applications, and in particular, some of the questionnaires that are required for those who borrowed greater than $2 million. So again, appreciate it. Sarah, Miroslav, thank you so much. For those of you who are going to be online next week, I'll see you next week. I'll be helping Margaret through that one on December 10th. Hope to see you all December 10th at 3 o'clock. Have a great night, everyone.
Thanks, everyone.